In this video, I'm going to talk about the Relative Strength Index, or the RSI. This is another really popular technical indicator. Now, most retail traders can probably tell you how to read this indicator and what actions to take when the RSI is at certain levels. But if you ask them, what do these numbers actually mean? Why are you buying below 30 and selling above 70? Maybe you won't get as many answers. I think that if we're going to use a tool, it's important for us to understand how it works. So today I'm going to attempt to unpack the RSI, how it works, what the equation is, exactly what it's telling us. And then maybe we can sort of like have a better idea to determine for ourselves if this is actually a useful indicator. Alright, so the RSI is a type of technical indicator that is known as an oscillator. That means that it's like a pendulum that swings between two extremes. The underlying assumption behind oscillators is that when the pendulum is at one of two extremes, it's most likely going to be swinging back because there's nowhere else for the pendulum to go. For the RSI, one extreme is the overbought, and the presumption here is that there's too much buying. So essentially, there's not much more room or momentum for buying to go, and therefore, the pendulum has to swing back in the opposite direction. So therefore, overbought is basically a signal to sell. Conventionally, overbought is when the RSI is above 70. The other extreme is oversold, and this is basically the presumption that there's too much selling in the market, and therefore it will come to a point where sellers are going to lose momentum. The pendulum needs to swing back in the opposite direction. Therefore, oversold is a signal to buy, and conventionally this is where the RSI is below 30. How do we get the numbers for RSI? Well, this is the formula. I know it might look like a lot, but let's break it down into two parts so we can sort of like see the process of how RSI is calculated. The first step in this equation is to determine what is the current relative strength. And the second step is to put this on a scale of 0 to 100. For relative strength, basically we look back at a specified number of days in the past, and we calculate a ratio of the up days versus the down days. The default setting for RSI is to look back at the last 14 periods, the last 14 candles. So in this example, we see how the prices have moved over a period of 14 days. What we're going to do first is we're going to determine what was the magnitude of the price movements every day. So from the opening price to the closing price, what was the percentage change? And we're going to get the relative strength based on a ratio of the sum total of the percentage upward movements versus percentage downward movements. So we add up the percentage movements for all the up days, and we also add up the percentage movements for all the down days. If the sum of the percentage changes for the up days is larger than that for the down days, then we're going to get a larger number for relative strength. And the opposite is also true. If the sum of the percentages for the down days is larger than the up days, then we're going to get a smaller number for the relative strength. If both of these numbers are equally balanced, the relative strength will be equal to 1. Alright, so our ratio calculation has given us a number for relative strength. However, this is going to be a bit difficult to use as an indicator because the number is going to range from 0 to infinity, whereby the midpoint actually is 1. So we're going to have a very weird looking lopsided indicator. And that is where the second part of the equation comes in. I'm not going to go into specific details of how it works, but in a nutshell, what it does is it converts the relative strength number into a scale that always falls between 0 and 100. And therefore, it's a lot easier to use as an oscillating indicator. When relative strength is higher, when we convert that to the RSI scale, it's going to be closer to 100. The theory is that the pendulum is now in one extreme, which is the overbought region, and needs to swing back in the opposite direction. In order for that to happen, the price will need to fall as well. Hence, RSI above 70 is considered overbought and is a signal that it's time to sell. When the number for relative strength is low, on the RSI scale, it will be close to 0. The theory is that the pendulum is now at an extreme, the oversold extreme, and needs to swing back in the other direction. Now, in order for that to happen, prices supposedly also needs to increase. And this is why when the RSI is below 30, it's considered to be oversold and a signal to buy. Now, if the ratio of up to down days is balanced, relative strength will be equal to 1 and the RSI will be close to 50. Wow, this makes trading look extremely easy, right? All you need is this one line and it tells you to buy here, it tells you to sell here. Easy money. But is that the case? Is it really that easy? Let's dig deeper. The underlying assumption behind oscillators such as the RSI is that when the pendulum is at either extreme, it must come back to what is normal. Now, this theory in and of itself is not entirely wrong, but it's also not law or certainty either. And this is because the RSI can actually remain in either extreme for extended periods of time. There could be, a long duration of time where there's a lot of buying or selling happening, and this could stretch for weeks or even months. Overbought and oversold. These are subjective value statements that cannot necessarily be applied to every single situation. For example, if we have a company with a lousy business and it's in a long-term decline and you just know that there's no hope for this business, no matter how low or how oversold the RSI goes, this company is dead in the water. The price is not going to come back up. So when we're trading or investing, don't ignore the fundamental factors. I know it's easy to overlook them. It's easy to just look at one single factor, one single line that tells you when to buy and sell, but there's a lot more to it than that. Secondly, even if it's true that a pendulum at extreme must move back in the opposite direction every single time, that does not mean that the price will also move in the opposite direction. Remember that relative strength is a ratio calculation of up days to down days. So we can have a really big price movement that pushes the RSI into overbought territory. But as we can see in this example, the pendulum can actually swing back from the extreme region. The RSI can move out of overbought region, even though the price simply does this. The price could stay the same or even increase even as RSI moves out of overbought territory. And that's because the relative strength is a calculation of the ratio of up days to down days. RSI actually changes as the ratio of up to down days changes, but that may not have any impact on the overall price movement. So while the pendulum analogy to the RSI theory may have some truth to it, that doesn't necessarily mean the price would follow suit. Thirdly, we go back again to the premise of RSI that when the pendulum is at an extreme, it has to go back to what is considered normal. If this was truly indeed the case, 14 periods is way too short to establish what is considered normal. When we're trying to establish what is average or what is normal, it's always better to have more data to analyze. The problem is when there's more data added to the RSI calculation, it makes the indicator way less sensitive. And that means it's going to give us less trading signals and less opportunities to become overnight billionaires. So that makes me think, when people aggressively promote indicators such as the RSI, what are their intentions? Why is it that they want us to be making way more trades? And one other thing. What is 14 days? Why 14 days? It's 1 day shy of 3 weeks. What's so significant about this period of time that we are using it to determine what is normal and what are extremes? Some people call oscillators such as the RSI leading indicators. But here's the thing. The RSI's calculation is still based off historical prices. We're still looking at the data from the last 14 days to calculate the normal and the extremes. This means we're using the RSI as a means of processing where prices have been in the past, and this tells us nothing about where prices are going to be in the future. Nobody knows what's going to happen in the future. Nothing can tell you definitively where prices are going or what you should be doing. So to be clear, I don't use the RSI in my trading or investing. Personally, I don't find it to be useful. So that's it for today's video. Like, comment, subscribe. If you found it to be helpful, I will see you in the next one.